Carl, how are you doing today?
I'm great. How are you?
I'm doing good. We were both talking about our crazy travel schedules and then how it hasn't been over the last 4 months. And you are overseas and your investments are over here in the US. But
Yeah.
so I've been, I don't, it's so funny because there was one of the podcast companies that reach out for interviews that I get every day. And then all of a sudden you came out, I was like, hey, actually a good one. And then like seeing your ads everywhere I don't know if I clicked on the website. So you get some cool stuff going on. And I think it'll benefit our audience in a lot of different ways because we got people looking to grow and sell, looking to grow, sell, and buy, but all the different angles. And you had just mentioned that you've been on every side of the table. So let's give the audience a little cliff note, maybe from the horse's mouth of, how over the last 30 years, some of the things that you've done and what you've seen.
Yeah. So I started my career in 1992. So I went to work for a Wall Street investment bank doing mergers and acquisitions. So that was an awesome kind of grounding in terms of being a deal maker. So bought and sold businesses for Microsoft, IBM, GE, Boeing, Lockheed Martin, all the big names. So I specialized in the kind of technology and the industrial sector. So I did all that. And then I left and did an MBA in Chicago in the mid 2000s. And then I ended up working for Hewlett Packard as one of their directors of M&A. So I was flying all over the world, buying businesses for HP. The largest deal we did was $13.9 billion. So it was really, really interesting stuff. And then my life massively changed 12 years ago. So it was the 1st of February, 2008. And I was in a boardroom in Moscow negotiating the purchase of a company. And my wife calls me, and she'd gone into labor 4 weeks early with our son. And I had to get myself back to the UK for the birth. And I made it with a few minutes to spare. And my little guy, Josh, he came out and I'm cradling him in my arms. And I just thought, you know what? I'm done. I don't want to work for other people anymore. So I quit. I walked away from, $1 million worth of stock options and I retired. And I was 37 years of age. This was back in 2008. And I was about 3 weeks into my retirement and I got really sick. I mentally just couldn't deal with the downtime, going from 100 hours a week, flying all over the world, boardrooms, deals, all that stuff. And I sat down with my wife and I said, what am I going to do? I can afford to retire financially, but my brain's going to kind of turn to mush. So my wife said to me, I'll never forget, she said, well, here's the cool thing, Carl. You've only got one skill set, but you're one of the best in the world at it. You know how to buy and sell companies. She said, so why don't you become a business broker? So I thought, great idea. So I set myself up and the first business that I found to sell, I just ended up buying it. Because what happened was when I was sat down with the seller, they didn't want to sell to a trade buyer. They didn't want to sell to a competitor. They were so proud of their brand and their legacy, and they were so fearful of their employees and being taken care of that they didn't want to sell to another company that would integrate the business and strip it down. They wanted to sell to an individual, and I said, well, okay, I'll buy the business from you. I'll do a leveraged buyout, which is a fancy Wall Street term. It's buying the business using other people's money. So I raised a bunch of financing on the strength of their balance sheet and their cash flows. I paid about half of the money at closing, agreed a seller note to pay the rest over time. And that was my first deal. I sold it later to the employees after about 3 years, made some money out of that deal.
You did an ESOP, the first one you did?
Yeah.
No shit. That's awesome.
Yeah. So I built it. We doubled it in size. I sold it to the employees in the management team, 7 figures, which was great.
How many years between when you bought it and when you sold it?
Yeah, 3 years.
3 years. No kidding, huh?
3 years. But after the first kind of month of being in the business quite a lot, I was only in there maybe an hour a week. I kind of developed the perfect balance as an owner investor. So not having to be in my business every day. So I was working kind of on the business, took some of the lead in the strategic work, but I let the management team and the employees basically run the business, drive the bus kind of day to day. So that sent me on a journey then of buying other businesses and targeting kind of owner managers that didn't want to sell out to trade buyers, wanted to sell to individuals that would keep the name, keep the brand, protect the legacy, protect the employees. So I kind of went through that process, bought a bunch of businesses. Some worked out really, really well. Some unfortunately didn't. Some small deals, some really large deals, like $20, $25 million deals. And then about 3 years ago, I was starting to get really kind of inundated by people that wanted me to teach them how to do this, wanted me to teach them the art and science of deal making, how to develop a deal making mindset, how to build relationships, how to find deals, how to close them, how to raise capital, and then how to grow and scale and optimize a business once they've bought it. So I decided to build an online program, an online system, which has gone really, really well. Today, we have over 5,500 people in that program, primarily on the buy side. Some of them are entrepreneurs that want to buy a business rather than starting a business. Obviously, I think there's a lot of benefits in buying versus starting. And then we're also coaching and mentoring a lot of existing business owners that they want to radically scale their business. And instead of doing it hustling customer by customer, they're buying other businesses as a way to scale and then combining them really synergistically with the business that they already have. So that's what we do. And because I come from a place of giving, I probably talk to 20, 25 sellers a week. And most of the businesses, I have no interest in buying. They're not the right fit for me. But I end up coaching them on really how to sell their business, how to separate themselves from the day-to-day operations so that they actually can sell the business to somebody
Sounds
else.
like we need to partner up. I got the sell side package and education teed up, and you got the buy side.
Yeah.
Carl, how many companies did you invest in, buy and sell, or actually go through the process with prior to launching the education a few years ago?
Yeah. So I've been party to well over 300 deals, close to about 340 deals that I've been party to. In terms of me personally buying and then selling, probably around 25 to 30 from 2012 up until the current day, because obviously I'm still doing deals. I still own a bunch of different businesses in different sectors, different countries. I do that through my private equity firm. So I have a PE firm in the US called Props Capital with some partners, and we're doing deals all the time. We're about to close on a couple of other transactions. One's a construction company. The other is a HVAC business. So one's in the US, one's in the UK. So still very, very active. So I'm one of those rare entrepreneurs that eats my own cooking.
That's awesome. So there's so many ways I want to kind of go with this, because I'll just kind of put up a couple pins in there, and if we can remember to go back to them, is like the size of the marketplace. And when you think about like the deal sizes, I want to kind of get, because I think the deal sizes, the marketplace, the market opportunities also impact the types of financing and the types of structures, which also I think lends opportunities to what you and I are talking about. And so like one of the stats that I have like gravitated to, Carl, over the last 6 years since I started doing this, is this U.S. Census Bureau study that said that 95% of companies are underneath 5 million in revenue in the U.S., which is like out of the privately held companies that have employees, there's only 6 million of them, which puts it at like 56 or 5.6 million that are underneath that. So all the private equity firms that I end up, that have been on the show or we interact with, it's like, hey, have you seen this 2 million in EBITDA company that's perfectly, sustainable, that no one knows about, that you can come in and buy? And it's like, well, it's going to be a little bit more work to find that. But then you get into the lower market, and there's this like drastic difference of, okay, you have a 3 million revenue company, owner operated, they haven't separated ownership versus their W-2 pay, which, you get into this deal structure on the size of these, it's mainly SBA loans or seller financing, or they sell to a third party. And there's just so few options, and the creative deal structures and all the things that you talked about, ESOPs, private equity, aren't available to 95% of business owners. or buyers or sellers. So there's this weird. I can tell you got something to say about it.
Yeah, so you're right. The data is incredible, and we focus primarily on businesses between kind of the 1 and 5 million revenue mark. Sometimes we'll go down to $500,000. If you go below a million or kind of 500,000 worst case, you tend to find that the business owner, doesn't really have a business. They just have a job in
Mm-hmm.
their own business, and all the processes are in their head. All the customer relationships are with the owner personally, and you buy a business like that, all the goodwill evaporates as soon as the seller cashes the check and kind of leaves the building. And then what we found is when you go over 5 million and 10 million in other cases, but kind of when you get into really an 8-figure revenue business, there's so much more competition out there. Buyers can come from trade or private equity. You've obviously got sellers who have really optimized their business. They've got management teams, they've got systems and processes. So they have separated themselves. And what I found at that level is sellers are a lot less concerned about the intangibles. They're a lot less concerned about employee retention, brand, legacy, continuation of their baby. So we focus on that 1 to 5 million range. And what's amazing is, when you talk to a seller in that space, whether they've owned the business 10 years, 20 years, or even longer, they've spent more time in that business during that time than they have with their own family. And it's like they're selling their baby.
Mm-hmm.
And um, and we've modeled this extensively over the past 5 years, and we've come out that 79% of sellers in the 1 to 5 million range value the intangibles a lot more than the tangible cash that they're going to receive. Yeah, they want some money for all their hard work, but they're prepared to be a lot more flexible and creative on the structuring of the deal because they appreciate that as buyers, we're going to be able to kind of cherish the legacy and the employees that we actually have. The other 20, 21%, sure, that they just want to sell, they just want to cash in, and that's completely fine. But the market data is crazy that there's over 2.4 million businesses for sale today in the US. Most of those are driven by baby boomers. You've got 10,000 boomers retiring every day. Nearly 20% own small businesses, and only 1 in 11 businesses will sell within the next 12 months. And there's a couple of reasons for that. One is that most people that want to sell their business, they've never been through it before. They're not being professionally advised. They don't know how to do it. And then secondly, there's a massive lack of qualified buyers that know how to do deals and know how to get the capital that's required to be able to structure a deal and close it. And that's what's driving me today. Because somebody asked me yesterday, I was on a TV show. Somebody asked me yesterday, why do you do what you do? You've made all this money, you're doing all these deals. Why are you coaching and mentoring these people on the buy side and on the sell side? It's because I really care about. There's a massive problem in this industry. The broker market is largely unregulated. I just really feel for the millions of sellers out there that can't sell their businesses. These are, in a lot of cases, really good businesses. They're being very poorly advised, and they just need the kind of the skills and the tools to know how to put a deal together.
I'm like almost jumping out of my chair because I just want to be like shaking the pom poms of what you said right now. I mean, it is super crazy. I totally agree with you because it's interesting when you get up to the higher revenue market like that you're talking about. Like you've got tons of options of capital structures, ESOPs, raising some money, private equity, earnouts. Like how creative you can get. First of all, really skilled advisors gravitate there because there's more money there. So then you have like this almost retail versus wholesale, almost back like the stock market brokerage world 30 years ago, right? Like I don't know that if you got a correlation between those two, but now literally you have like this real estate market of the business brokers that are now responsible for 95% of the companies, where you have like, if you think about like the size companies that you talked about too, you could have an $8 million revenue company that's doing 800 to a million in EBITDA that gets a listing, literally a listing for their 50 employees. Then they go, wait a second, this is only worth 3x or 4x because they haven't done anything, and then they pay down the taxes, pay down the debt, and they walk away with 700 grand. Yet the person working at Target for 30 years is going to retire with 2.4 million.
Yep, exactly.
It's like
crazy.
it is crazy. So what are your thoughts? Like, so given the fact that we kind of set the groundwork and we had an agreement of this, and like, and because we help people buy and sell too from the fractional CFO and the educational perspective. So we play in the same marketplace, but from a different lens. I think we can validate almost everything you said. So then you say, okay, well, I see a lot of, and I'm curious because like from the volume of people that I talk to, I do see more buyers that are happening. I agree that there's a huge amount of unqualified like buyers for the wave that's coming over the next, and it's going to be a trickle with the boomers that as they go over the next 5 years. But like the SBA loan is like, there's so much restrictions on the financing of this. Cause if you do an SBA loan, it's, you could have 10 to 20% down, it's got some good terms from the duration, but you can't do earnouts, you can't do employment contracts. When you actually model it out from the cash flow, Carl, it suffocates the business because of debt. So like, then you go, okay, well, all the creative things that you could do, the people that should buy the business who might be 35 or 40 don't have $2 million in cash to put into the bit. So there's this weird void. And I don't know if that's some of the stuff you're trying to help, or what are your thoughts on that?
Yeah. So I'm not a massive fan of the SBA, if I'm being honest. I think the SBA works better when you own an existing business. Clearly with the SBA, you need that personal cash injection, or you've got to go and partner with an investor who will sign the personal guarantee and give you that equity injection. But what I found modeling deals, I've done an SBA deal, done two actually, where because you're amortizing the loan over such a long period of time, on the deals that I did, because you're able to pay the seller such a huge proportion of the deal at closing, you can generally get a lower headline price. And then because you're amortizing that debt over a really long period of time, from a cash flow perspective, it really works. Most of the deals that we tend to get involved with, and most of the students that we're mentoring who are doing deals, they tend to do deals on a mix of asset-based or cash flow lending, some equity investment either from themselves, or they'll go and partner with an angel investor, somebody that can add a lot of value to the deal and the business once they've acquired it. And then also with seller financing. Now seller financing is always a tricky subject because you've got to build really solid relationships. It's like walking up to a girl in a bar and asking her to marry you. It's never going to work. You've got to date that person and spend a lot of quality time with that person. And it's the same in deals. So the strength of the relationship you've built and the credibility and that you get the seller to know you, like you, and trust you, then it opens up lots of opportunities for kind of seller financing. And you'll always have the security question. Sometimes a seller might want you to personally guarantee that note. Sometimes they might want to claw back on the equity if you don't pay. There's a lot of things around that. But for me, what I figured out versus when I was on Wall Street. When I was on Wall Street, M&A was all about financial engineering. When you're doing deals in the kind of small and medium space, these $1 to $5 million deals, it's about psychology and it's about relationships. I've looked at businesses. I've looked at two identical businesses almost in the same sector, did the same thing, same financial profile, identical businesses. One was owned by a 35-year-old entrepreneur, really having a lot of fun, enjoying life. The other was owned by a 60-year-old retiree, sick, highly demotivated, but still a great business. You can buy the latter business for 2 to 2.5 times multiple and pay 25% down. The first guy, you might want 5x, 6x. Hey, you might even want 10x for his business and want most of that money at closing. So that was the big step change for me when I got into this in the kind of small to medium market. Is just how much this game is about psychology and relationships. When you're a Wall Street guy and you're doing billion-dollar deals, it's not about those things. It's about the financial engineering. But it's easy
because
when
everybody
you're
at that point are financial engineers, right? Buyers and sellers. Everybody's doing financial engineering. That is the sport, and then the business is just the mechanism to do the financial engineering. Where you get into the lower place. And I mean, it's truly people that started as tradesmen. I saw on your YouTube, and you're holding up the E-Myth, right? People that started out doing a job, right? And like,
Yeah.
I've interviewed hundreds of people, and our model is about like, the business is a derivative of the owner's personality for the most part, who they chose
Yeah.
to hire, the clients that they chose to work with, the suppliers they chose to work with, everybody, that their whole ecosystem is kind of like a reflection of them as a person.
Yeah.
And it's like, I mean, the psychology is, I mean, it's actually science. Like, they can show that it's like, hey, this is like almost decoupling your identity from that ecosystem, and you have to be financially rewarded for it. And I see, like, so it's funny because I don't know if you saw our 5 principles, but the first one starts with, what the hell do you want? You have to start with that. And then the next one is, okay, what are your financial targets? Because I think there are situations where like the business owner can't sell. Like, by the time they run the net proceeds, if they even know what that means, they're going, I can't retire. And especially if they do an SBA deal and they get kicked out and they can't have a job. They're like, I can't literally afford it, even though I want to. So you kind of have to have both those in balance. I mean, how do you see that happening as you look at these deals that you've looked at? How are some of those two worlds getting melded together to actually solve the problem?
Yeah. So on the SBA side, there are ways around that. You can retain the previous owner as a consultant. The SBA limits you initially for the first 12 months, but I don't think they ever check that you can keep rolling those contracts forward. And what you can then do with that is almost give them a kind of pseudo earnout, where you, on the consulting agreement, you can give them points of revenue, over above a certain amount, or points of profit over and above a certain amount. So that's a way to kind of hack an earn out into an SBA deal. But clearly, one of the things with sellers, and when I look at a business and I think, well, I'm not going to buy it. There's no way that the seller's going to get what they need. I'll actually coach them on how to grow and improve that business so they can sell it. And I'll coach them on really three things. So first of all is how they separate themselves, from the business. One of the number one reasons why businesses don't sell is what I said before. All the goodwill's going to evaporate as soon as they leave. For somebody to sell a business, they've got to extricate themselves from driving the bus. They've got to have a team and processes in place that are going to run that business. And I ask the question when every seller I talk to, I say to them, if you didn't go into your business for 30 days and you didn't have any phone calls, any emails, you were marooned on a desert island, what would happen to your business? And most of the time, they're in shock. They're like, well, it would die. It would die within a week. Okay, well, then no one's going to buy your business. Why would they? No one's going to buy your business unless it's a trade buyer that's basically buying your customer base.
Because they know how to do it.
Yeah, your product or service range, and they're just going to plug it in to what you have already, and then let everything else go. But most sellers don't want that. They don't want that. I bought a company a couple of years ago. It was a media business in California, in Burbank. I remember sitting down with the seller, and I said to her, to your point, I said, what do you want? What does the perfect deal look like for you? And she said, well, I've got three requirements. She said, the first one is you can't change the name of the business and you can't change the logo, because my husband started this business in 1985 and we're so proud of this logo and this name. So if you buy it, you can't change it. I went, okay. She said, number two, you can't fire anybody. If you buy this business, you've got to keep the employees. If they want to leave of their own accord, that's fine. But I don't want you buying it and then stripping people out. We're like a family. You've got to take care of them. She said, I want that written into the agreement. I said, okay. She said, and the third point, she said, I want enough money at closing to pay my closing costs, and to go on a short vacation. And then I want essentially $6,000 a month for the next 2 years. And I said,
Pension.
perfect.
Right.
I said, so you probably need 50 grand down and 6 grand a month. She said, well, no, I'm thinking more around kind of 25. She said, but I'll just take the money out of the business. I went, okay, great. So you take 25 grand out of the business at closing, that covers your costs and you can go on a vacation. I'll just pay you $6,000 a month for 2 years. She went, really? You do that? I said, of course I would. Yeah, that's fine. Which meant I bought that business and I didn't have to spend any of my own money. I used the business's own resources and its ability to generate cash flow. So I did that deal. And the first thing I thought is, well, I don't want to run this thing. So I went and found a smaller version of this company. And I called Paul, the CEO. I said, look, buddy, I said, I'm dragooning you to be the CEO of my new business. We're going to park your existing business into it, and I'm going to give you 40% of the equity. And then after 2 years, I'll sell it to you. Once I've paid the seller off of the original deal, I'll sell you the other 60%. And we've just done that deal. So he did it. So we came in, we grew that business, we integrated his business into it. He just bought my 60% equity.
So Carl, I think that is, you could do that so many times, because by the time, and I don't want to kind of give you a couple of my insights that I've learned over the years of why I think some of these challenges arise, is like, and then curious on what your perspective is on it, is like, so as these business owners grow like this, and then there's almost like this plateau that I've seen where it's like finally they can make their six-figure income for the year, and they don't know anything about ownership versus W-2 management role, like payroll. Like you're getting paid for being the CEO, right? So that 100 grand is from that. But then it's like this blender of distributions. Should I pay my taxes? Do I get my salary? Because of the financial like clutterness of it. So what happens is it's like this, whoop, and then there's this stickiness at that, which could be like a couple million in revenue or whatever it might be. And so like when I see these problems of like, so like if that problem happens and then that situation arises and that you just described, it's like, please take this job, this big, huge income stream, and just let me decouple it. And I see it like, if someone understood, like, hey, they understood what you and I just discussed, they're like, well, they might be able to free themselves without potentially selling it yet and grow it a little bit more, then sell, or like, but the challenge that I see is that they haven't gotten to the point where they can afford to reinvest, because they're like infused with that six-figure cash flow check. Have you seen that? Is that accurate, or what's your thoughts on like?
Yeah, so that's pretty common. That's pretty common. But theoretically, for an owner of a business that's only making $100,000 a year in SDE, then they've either got a $500,000 business with a 20% margin, or they're just cracking seven figures, and they're making 10%. One of the challenges, outside of the kind of owner versus operator conundrum that we talked about before, one of the other challenges that I see an awful lot with the vast majority of businesses that I speak to is they don't know how to scale. They don't even want to scale. The bulk of their revenues are coming from repeat customers and word of mouth referrals. And don't get me wrong, I love those businesses because they're almost on autopilot. And if they've got loads of referrals and repeat customers, they have a band of raving fans. But most business owners that I come across, and most of the baby boomers, they haven't really kind of adopted a lot of the new ways to do marketing. So they might not have any direct salespeople. They're not leveraging social media. They don't go to events. They're not actively going out there to generate new leads and convert those leads into new customers. And a lot of the things that I see as well is a lot of these business owners, they're bending over backwards for customers. Everything's bespoke. So they can't scale because they've got, really kind of
Saturday morning phone calls from customers.
Yeah, people dependent businesses. It's not a repeatable product or service that can scale. And you build a sales funnel, you figure out what your conversion metrics are, you buy media or you advertise, and you just convert and you scale and you scale. You've got that awesome repeatable process. And it's so rare to kind of see that. But those are the businesses that sell for 5, 6, 7, 10 times profit, whether it's cash flow, SDE, EBITDA, doesn't matter. But 95% of the businesses in the market and most of the ones I ever speak to will see, they're not in that place. They're not in that place. But what's really interesting to kind of plug into this is the number one exit strategy in the United States for a small business owner is actually to close the doors and turn off the lights. And that devastates me. That's one of the things that drives me. 595,000 businesses in 2019 closed the doors and turned off the lights because and most of these were good businesses. They weren't bankrupt. They hadn't filed for bankruptcy. It's just that the seller wanted to sell, didn't know how to do it, couldn't find the right buyer. So they basically liquidated their balance sheet. They cashed in all their assets, they paid down all the liabilities, and then they just took the shareholder
Oh,
funds.
isn't it just sad? I mean, like, well, for them, for the opportunity, for the customers, for like, I mean, in Carl, you layer on once the PPP rolls its way through the system and the new economy actually reconciles with what's going on. And like I'm like it's there needs to be a way to fix this. I mean, like because I agree with you. I mean, it's super sad. And yeah, it's going back to what you're saying is like, when you talk about scaling and like trying to get out of this. And like, I also think like the example that you talked about, the cash flow and not knowing how to scale and the kind of the whole blender. I've seen this even the layer up the market in the mid market of, business owners who are you call it a couple $1,000,000 where they get used to those distributions. But by the time they value the company and run their net proceeds, they're living $500,000 to $800,000 lifestyle. It's just the same problem. It's just another zero. It's just, is it, when you think about, like, I'm curious, as you went from like your M&A world of financial engineering to this, how much of these issues become financial education problems from the owners of understanding, like, yeah, they want to do these things, but they don't know how to look through the windshield and understand how to get there?
Yeah, so I think it is a problem, and I think one of the really interesting things is that for most business owners, they've never been through this before. So this is technically their first deal. 90% of business owners that sell actually founded the business; they didn't buy it, so they've never been through a deal process, and they lack the psychology and the financial chops to be able to do the deal, and a lot of them, they're poorly advised. I think partly that is their own fault, that they're not prepared to pay their lawyer or their CPA or their tax advisor, to really navigate them and guide them through the transaction. So I think that's a major problem, and just that lack of advice and handholding. The number of businesses I've bought where I've had to hold the hand of the seller through the transaction and almost kind of like pseudo advise them. I'm saying, look, buddy, I'm buying your business. I could be anybody. You've got to get independent advice. No, I trust you. You're really smart, and you've been doing this for a long time. And I know you're going to do the right thing by me. I'm like, I am, but dude, you've got to get a lawyer on board and go and see your advisor on the tax perspective and have him walk you through, the best way to structure this from your perspective, so you're maximizing the dollars that they're gonna stay in your jeans and they're not going to go to the IRS or our equivalent in the UK. And that's a big part of building the relationship. But for me, there's generally a very poor level of advice given to small and medium businesses. When you become a $10 million business and you
Everybody wants you. You're on the cover of magazines and
yeah, when you're at $10 million as a business and you're cranking $1 to $2 million in free cash flow, everybody wants to advise you, and you can obviously afford.
My analogy I've given before, Carlos. It's like the picture of like the big whale, the great white whale, and like the little minnows that kind of flow in. It's like you have the cash flow, and then all of a sudden they get all the people that are latching onto that cash flow, and it's not as viable for the advisors or advice to go downstream. And like, so it's interesting because like you've kind of been over the last few years building this process and solution from getting buyers educated to do this, because they at once they thought that the capital was a problem. Now that you're kind of educated, I want to get into that and like how you're educating them on the to structure the deal. But for the sellers, it's interesting because like after my dad and I sold in 2014, went through the whole like learning experience and, a couple hundred podcast interviews in. And I'm like, I've been trying to solve the problem for the business owner that currently owns it to like essentially shift their mindset and say, okay, like how to educate this. I went through renaming this, Carl, because it was like growth and exit, and people like exit freaks everybody out. So we renamed it the intentional growth framework to grow intention, but it's educating them on this. And it's like I've like trying to find how to inject at the right moment when they're open to learning about this and getting their head out of their business is just honestly, it's probably one of the most difficult things that I've ever done in my life, is just trying to figure out how to do it before they're too burnt out.
Yeah. So you've really hit the nail on the head there. And I think a lot of the challenges are that, most business owners, they're working in their business, not on their business. So they don't have the time, they don't have the mental real estate available to really kind of think through, what that process looks like in terms of the transaction, in terms of the financing, in terms of the psychology, the emotions that sellers go through when they sell a business, especially for the first time. It's up there with getting married and buying real estate. We all remember the first house we bought, how stressful it is. We all remember when we get married or we have kids, just how emotionally draining those things are. And I think selling your company is way, way, way up there. And most sellers, they're just not geared up to go through it properly. And I think a lot of them, they haven't even really figured out, what are they going to do when they come out of the transaction? If they successfully close and, they bank a significant check at closing, it's like, what are they going to do? And it was like me back in 2008. Whilst I hadn't sold a business, I cashed out of HP and I had, I had some money in the bank and, didn't have a financial worry. But 3 weeks in, I was mentally ill. I couldn't function. I needed to get back in the game and do something with my life. I still had too much to give. And a lot of the sellers, I bought a business once off a gentleman. But one of the deal origination techniques that I teach my entrepreneurs is what I call the direct approach. So, as you know, a lot of deals get listed through business brokers, and obviously you can find deals through your network and various things. But one of the things that I teach as well is, build a list of businesses you like. Go to Info USA or Hoover's and, pull a list. Let's say you wanted to buy an engineering company within 50 miles of Chicago. You can get that data quite quickly, and you can write to the sellers in a very confidential way and inquire as to whether they want to sell their business, and you're building rapport in that document. And I still do that today. And so I sent some letters out. This was 2013, I think. And I was looking in the engineering space at the time. And this guy called me the following day, and he's like, "Got your letter, very interested." He said, "But I need to see you today." He said, if I don't sell this business by Friday, I'm going to close it down." I'm like, "Really?" He said, "Look, come get in your car, come see me." So I got in my car, I drove like 90 minutes, went to see him. And I went into his office and the guy was a wreck. And I'm like, "Jeff, what's the matter?" He said, "Well, I just found out last night that my wife's got advanced cancer and she's going to be gone within the next 6 weeks. And I do not want to be in this business every day. I got to be with her. I've neglected her for years. I've been running this thing. None of the people in my business are capable of taking it over. So if you want it, buy it off me for £1. Give me a share of the revenue splits, or give me a share of the profits if you want. But take it on. You got to do it now." So he calls his lawyer. His lawyer comes in, gives me a contract. I buys the business there and then, and he leaves. So 3 months later, I've installed a GM. We've started to grow this thing. He calls me up, and obviously his wife had sadly passed. And he's like, "I don't know what to do with my life." He said, "Can I come back and work for you?" I said, "I'll tell you what I'll do. Why don't you come back? I'll give you half of the business back and let's run it together." So we did. So he came back. We ran it for 2 more years. Then we sold it. And he was able to retire then with a chunk of change to get on with his life. But if he couldn't have sat at home after his wife passed and done nothing. He needed to come back. That business had been his life for 22 years. and he needed to come back and get back involved. So
Well, it's interesting you bring it up in that context, Carl, because like as we have built our education platform with the intentional growth principles, like understanding what you want and then understanding your financial targets and essentially understanding the value of the business as it relates to your overall ongoing cash flow and your net worth and how it fits into that. Like again, could be breathing like for you and I, but a lot of these people they don't understand it. But then they can make the decision to say, "Hey, I'm going to sell partial of it for the, segmenting the ownership from the management role, and then say I'm going to sell some or all of it. What it could be an ESOP, could be to someone like you, could be a seller, it could be anything, but they're choosing to stay in it, and that's going to impact how they want to structure the deal. Because, like, I mean, you're so right. I don't know if you knew, but before this, the name of this podcast, I actually the podcast was named Life After Business for 3 years.
wow.
So yeah, it was like because it was the same thing. We're like, what the hell are we gonna do? I mean, and you start to realize that most people, this is their passion. And I'm not a golfer. Most business owners, I actually did a podcast recently about flow and how business is actually a psychological addiction to being able to actually engineer your optimal state of human being.
Yep.
Like, so it's like this it's actually an addiction, I believe that. And like there's brain science out there that shows that if you get someone out of a business, they can't get back in the flow. Sudoku and word puzzles and all that shit is not going to satisfy the rush that you got out of a business.
No, you're absolutely right, and I'm the same. I sold my largest business last year to a big corporate in the US, and I could have completely retired. And my wife said to me, "Is that it? Are you done?" I'm like, "Nah." She said, "Well, why not?" So I'm 50 this year, and I said to my wife, "Look at Warren Buffett, still works 60 hours a week. Look at him; he's like 80 something." I said, "I probably won't work till I'm 80." I said, "But I got another 10 more years because I don't have any hobbies apart from working, being with my family, and cycling. I don't do anything. I don't play golf. I don't do anything. So I don't know what I would do with my time. I would get ill again. So I have to keep kind of hustling. This I've been doing this for 28 and a half years. There's no way I can give this up. So you got to
So,
keep
Carl, do you
going.
think it's because, like, I think about, like, because I agree with you wholeheartedly. Like, I will literally be doing this till the day I die because it's so freaking fun. And like, my business partner is 63, and they're like, well, what's Pat's final goal? I'm like, he's going to be looking at a deal on the financials on his last breath. Like, I totally believe that. But it's like, and then people, it sounds, what's the right word? It sounds like we're doing things that we're not advising, because if we never want to sell because we're doing this and we're looking to expand our portfolio and things down the road, why would we convince other people? And it's like the whole point, I guess, of how I've tried to articulate it. I want to hear how you would describe this is, once you get into the world of M&A, it's kind of like the end result, right? Buying and selling companies it's financial related, it's economy related, it's people related. You could throw a twist of conscious capitalism, capitalism in there. Like, it's literally kind of like the end of it. So that become like, the analogy I've given is like in the E Myth when Gerber, not Scott Gerber, what is it, Michael
Michael
Gerber?
Gerber.
Yeah, when Michael Gerber explains that it was like the business of McDonald's, not a restaurant. It's like a shift in mindset to say, like, this is it, not the actual trade. I don't know. Am I saying that right? Like, what's your
No,
thoughts on
you
that?
are. Yeah, yeah. McDonald's sells burgers, but it's not in the burger business, is it? It's in the distribution and real estate business.
Mm-hmm.
Knowing what business you're in and what business you should be in, it is very, very different. One of the best pieces of advice that I give to sellers once they leave their business and they need that mental stimulation of staying in the game is to become an angel investor and partner up with entrepreneurs that are looking to go and achieve results that, as the seller, they've achieved. And I either get equity in their businesses, either consulting for equity, so they're advising and partnering with them, and instead of getting paid, they're getting a share of the business, or they actually physically invest. And we advise a lot of our buyers to do that. So when you're buying a business, if you lack some of the skills that are required to drive that business forward, or you maybe lack some of the strategic chops that you would need, and you need capital to close the deal, go and partner with an angel investor that A, has got the money, and B, has got the life skills and the gray hair and the experiences that are A, going to add a lot of value to the deal, and B, are going to add a lot of value to the business once you've acquired it. And whether they invest or they're just on your board of advisors, it doesn't matter. They're there as a value add and can really make a difference inside of that business. So I think for a lot of sellers, I advise them to go down that route and stay in the game and just give back and help other people. And obviously, make financial returns in most cases as a result of that.
So as we're wrapping up here, I mean, you've built. So I want to give you some time to explain your educational material. And before you do that, Carl, I think because I have a pretty good mix of our listeners that are sellers learning this stuff, because I think it's important for them to understand deal structure so they can actually have a good conversation and they can be more intentional with the people that they're choosing to sell to. But maybe a little takeaway for sellers and buyers, as they're going into this journey, like what to accomplish your goal of minimizing the amount of business that I got to shut doors. What kind of advice would you give the listeners?
Yeah, so let me give you my top 3 or 4 pieces of advice for sellers first of all. So point number 1 is you have to separate yourself from the business. It's going to be very hard to sell your business if you are the business. So you've got to get out of your day-to-day operations. You've got to work on your business, not in your business, and make sure that you have a management team, even if it's 1 or 2 people, and a set of systems and processes that can be transferred to the buyer. So that's the first point. The second point is get good advice. Make sure that you have your CPA or tax advisor on standby, giving you the best advice, and a really good lawyer, not the family lawyer down the street that does wills and divorces. A lawyer that's they could be small, but a lawyer that's got experience in the M&A space, knows how to do deals, knows how to negotiate, knows how to protect the seller in terms of warranties and indemnities and all those different things. And then the third thing is really think about the scale. So when you're selling the business, for any seller, you've got to think about, there are only three types of buyer. So as a seller, you can sell to an individual. So it could be a management buyout from somebody within your business. It could be a management buy-in from an entrepreneur or somebody like me. Secondly, it could be a private equity firm where they're cashing you out for the majority of your ownership. You're staying in for a bit and then you sell out the rest, or you're selling to a trade buyer. And all those deals are different. If you're selling to an individual,
what about ESOPs? I'd throw that on there, right?
yeah. If you're selling to individuals, you're going to get less money for your business because the individual doesn't really have any leverage. They don't have an existing business they can connect with to generate synergies. If you're selling to a trade buyer, then obviously you get all those synergies and all that cross-selling. So a trade buyer is going to ultimately pay more money and they've got a lot more access to capital. But there are risks of selling to trade buyers. They might rip the company up and just take what they want. And for some sellers, that's great. For most of them, from my experience, that's not. So those are my best pieces of advice, to sellers. And obviously, to really scale a business and make it infinitely more valuable, before you sell it, go and buy another business and kind of bolt it into what you've already got. My best advice to buyers, whether they're individual or not, is number 1, stay in your lane. If you've never bought a business before, go and buy a business in an area that you understand, you're passionate about, and you can add value to. So if you're a web designer, go buy a web design firm or even an IT services company. Don't buy a gas station or a laundromat because you don't understand.
Because it makes sense.
It just makes sense. A lot of people, they come into my programs, they get deal heat. They go to bizbuysell.com or they talk to someone in the network and they say, Carl, I've got this great deal. It's a chemical processing business. I'm like, sure, but you're a sales guy for IBM. Why on earth would you want to buy? Yeah, but it's got great cash flow. Yeah, so, but you're not going to better any value to that business whatsoever. Go, the 74,000 IT service companies for sale in the US. Go buy one of those. You can really add value. The seller's going to think you're super credible because you're from the space. You work for IBM. You can add so much value to that business. You've got a network you can plug in. You can scale that business. You might even do a roll up. You can buy several and put them together. Do that. And they say, yeah, okay. So
Versus
stay in
spending
your
the
lane.
next 36 months understanding what polymers are.
Yeah. So like, it drives me crazy that people don't stay in their lane. And I think the other advice I give for buyers is, remember, it's more about psychology and relationships than it is numbers. Numbers are important. Obviously, you've got to value the business. You've got to structure the deal. You've got to make sure that the business is going to throw off enough cash flow to service the deal that you're doing. But that's the mechanics. You don't even get there if you haven't really figured out the seller's psychology and you haven't really built the strength of relationships that you need, both with the seller and your advisors and the financiers. And again, if you're buying in your space, that is so much easier. If you're the IBM guy and you go and sit down with the chemical business owner, imagine that conversation. That's not going to be very interesting, is it? If you're staying in your lane, wow, you
Yeah.
you can really have some magic moments in a deal like that. So
One
that
last
those
question. One last question. Then I want you to give your place of where to find the course and the material and everything is.
Oh,
What does the word intentional mean for you?
intentional for me is having a mindset and a purpose and the fuel to follow through on your goals no matter what. It's being ultimately committed to achieving the outcome you want, but staying flexible in your approach.
Wow. I think I might have to actually transcribe that and put that on the website. So what's the best place to get in touch with you and your materials?
Great. So we've got some free training that we're letting people have access to, just to see whether buying businesses is of interest to them. So if they go to trainwithcarl.com/intentional, they can download that training, go through it. And then for people that want to take it further and want to join one of our programs, there'll be lots of opportunities to do that as well. But first point is, go through that free training. If it's for you, then great. We'll welcome you into one of our training programs.
Carl, I had an absolute blast. Thanks for coming on the show.
Thanks, buddy. Great to be here.